Hey everyone, it's Emily. Today we're taking a closer look at a medtech powerhouse that plays a huge role in global healthcare. Becton Dickinson, ticker BDX. They just released their latest earnings. The stock reacted sharply, and there's a lot more happening beneath the surface. So the big question is this a hidden opportunity or a warning sign? Let's break it all down together. Before we jump into the numbers, let's talk about what Becton Dickinson actually does. This is a company that touches almost every part of healthcare: needles, syringes, drug delivery systems, tissue regeneration products, diagnostic technologies, and connected care platforms. They hold leadership positions in nearly 90% of the markets they operate in, and more than 90% of their revenue comes from consumables. In simple terms, hospitals rely on Becton Dickinson every single day. Now let's talk about the latest quarter. Becton Dickinson reported earnings per share of $3.96, which was a solid beat. Revenue reached $5.9 billion, showing strong year-over-year growth. But despite these results, the stock dropped almost 8% immediately after the announcement. So why would a stock fall right after an earnings beat? Let's dig into it. The market focused on what's coming next. A portion of Becton Dickinson's business is under pressure, especially in China, where revenue is expected to decline at a mid-teens rate. Vaccine-related revenue is also projected to fall by roughly 25%. On top of that, demand for their Alaris infusion pumps is cooling after a period of unusually high sales. These challenges affect only about 10% of the company, but they were enough to overshadow the positives. Here's what investors shouldn't miss. The remaining 90% of Becton Dickinson is still expected to grow at mid-single-digit rates next year. Segments like PureWick, tissue regeneration, connected care solutions, and advanced patient monitoring systems continue to deliver double-digit growth. Their interventional segment in particular is performing extremely well. So even though a few areas are slowing down, the core of the business remains strong. One of the biggest upcoming catalysts is the transaction with Waters Corporation. Becton Dickinson is set to receive $4 billion in cash, and management plans to use at least half of that amount for share repurchases, starting with an immediate $250 million buyback in the first quarter of 2026. Share buybacks reduce the number of shares in circulation, which typically boosts earnings per share over time. This has the potential to create significant long-term value. The company's internal improvement program, known as BD Excellence, is also paying off. They've achieved strong productivity improvements, higher manufacturing efficiency, and meaningful expansion in both gross and operating margins. Delivering margin expansion in a complex, regulated industry like medtech is not easy. Yet Becton Dickinson has managed to do exactly that. If you value stability, Becton Dickinson really stands out. They have increased their dividend for 55 straight years, a level of consistency you almost never see. Their stock also carries a very low beta, around 0.29, meaning it tends to move far less dramatically than the overall market. This combination of low volatility and a long dividend streak makes the company particularly attractive for long-term investors. Of course, there are still risks to consider. Free cash flow dropped roughly 14% last year due to inventory increases, tariff payments, and other one-time items. The China environment remains challenging, especially with government-driven pricing pressure. Vaccine revenue is shrinking faster than expected, and several analysts have recently lowered their earnings forecasts. These issues could weigh on the stock in the short term. So let's put it all together. If you're in the bullish camp, you'll point to a rock-solid consumables business, improving margins, strong demand for innovative products, and a huge cash infusion that could boost shareholder value for years. If you're more cautious, you'll focus on the China slowdown, the vaccine decline, and the possibility that 2026 might be a slower growth year. Both perspectives have valid points. It really depends on your time horizon. Here's my honest view. Becton Dickinson looks like a high-quality company dealing with a temporary slowdown. The underlying business is solid, the margin story is strong, and the upcoming cash inflow could be a major catalyst over the long term. Short term, we might see volatility, but long term, this dip may turn out to be a very attractive entry point for patient investors. If you enjoyed this breakdown, don't forget to hit like and subscribe. It really supports the channel. And if you want deeper weekly analysis on US stocks, make sure to check out the US Stock Stories Patreon as well. Thanks for watching, and I'll see you in the next analysis.